This stock is up over 300% this month. Reddit's ablaze. The memes are flying. But in the background, analysts are quietly whispering about an $82 price target. So what's the real story? Is Opendoor just meme fuel, or is it a multi-bagger in disguise? Let's dive deeper into what could be a pivotal moment in the stock story. Opendoor just wrapped up a wild week, finishing at $2.54 on Friday, locking in another 5% gain and capping off a month-long run of over 300%. But now, as we head into the new trading week, the spotlight shifts to Monday, when the highly anticipated reverse stock split vote will be held. But rather than just covering the news, we're going to take a different approach: game theory. What are the strategic decisions at play here? What are the potential outcomes? And how could each player's move shape the next phase of this retail-driven rally? Let's break it down. First, we need to define the players. There are three main actors here: the retail investors, the institutional holders, and the company leadership. Retail investors are driving the current momentum. They're on Reddit, StockTwits, Twitter, and Discord. They're posting charts, analyzing filings, making memes, and buying the dip. They've powered Opendoor's recovery and have shown an incredible amount of conviction in recent weeks. But they also tend to be suspicious of reverse stock splits, which are often viewed as a sign of weakness, a company trying to artificially inflate its share price to avoid delisting or maintain appearances. Then we have institutional holders, hedge funds, index managers, and long-term value investors. Many of these players are more focused on maintaining compliance and navigating the company's regulatory obligations. For them, a reverse stock split is a neutral or even positive signal that shows the company is serious about cleaning up its share structure and reducing volatility. Finally, the company's board and executive leadership. They proposed the reverse split as a safeguard, not as a signal of desperation, but as a contingency plan. Their recent statements have clarified that the split will only be used if absolutely necessary to meet NYSE compliance or maintain flexibility for capital structure management. In other words, they want the option, not necessarily the action. Now here's where the game theory comes in. Let's play out the scenarios. Scenario 1: retail votes against the reverse split. This could be seen as a power play by retail to retain influence. It would generate major buzz across financial social media platforms. The vote failing might signal confidence in the stock staying above compliance levels organically. It could attract even more attention from meme traders and speculators who view it as a symbolic victory. However, this carries risks. If the stock were to slide back under $1, for any reason, the company would have no recourse. That would create real compliance risk. So while a no vote might feed the meme cycle and short-term sentiment, it could backfire if the rally loses momentum. Scenario 2: the vote passes, but the split isn't used. This is arguably the best-case scenario. The board gets the flexibility they want, but retail traders see that management has chosen not to exercise the reverse split. That shows restraint and confidence in organic price action. It could be seen as a signal that the company believes its fundamentals are improving enough to justify the current share price. In this case, both sides win. Retail retains momentum, the company maintains compliance tools, and institutions stay calm. Scenario 3: the vote passes and the split is executed. This could create volatility, no question. We often see short-term drops after reverse splits as traders react to the optics. But if the rally is strong and the company has positive momentum, the market may digest the move quickly. Especially if earnings are just around the corner and investors believe stronger results are on the horizon. Now let's take a step back. Regardless of how the vote goes, there's a bigger picture to consider. Opendoor isn't just surviving on meme hype. It operates in a massive sector, the US housing market. And there are growing signs that the housing sector may be on the mend. Mortgage rates are starting to stabilize. Home inventory is beginning to recover in key markets. Consumer confidence in housing is inching back. For a company like Opendoor, that could be a game changer. More transactions mean more revenue. More volume means more opportunities for margin improvement. And as traditional brokerages struggle with outdated models, Opendoor's tech-driven platform might finally get the tailwind it needs. And then there's that wild price target, $82. Is it realistic? Not in the near term. But it serves as a reminder of how big believers view the long-term potential. If the market recovers and Opendoor can scale efficiently, the upside is massive. So what should we watch next? First, Keep an eye on pre-market action Monday. That will tell us how traders are positioning ahead of the vote. Second, monitor social sentiment. If retail rallies around a specific outcome, the momentum could intensify. And most importantly, focus on earnings in August. That will be the real litmus test. Are margins improving? Is revenue growing? Has the company stabilized its cost base? These questions will determine whether this 300% run is just a flash in the pan or the beginning of something bigger. To wrap up, the reverse split vote is important, but it's not the end of the story. It's one piece of a larger puzzle that includes strategic decisions, market recovery, and retail conviction. Game theory reminds us that the outcome depends not just on what happens, but on how the players react to each move. And right now, Opendoor's players are very much in motion. Stay sharp, stay informed, and we'll see you in the next update. Thanks for watching. Don't forget to like and subscribe if you're riding the dollar open wave. Let's see how Monday plays out.